There are thousands of dividend stocks trading in North America. So, how can investors cut that list down and find those hidden gems? Well, we're going to hear 12 golden rules to help investors find those undervalued dividend stocks, the ones that may offer long term upside potential as well as attractive income yield. So, let's hear all about how it's done. You're watching Inside Investing. Hello, everyone, and welcome to Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and joining us in this episode is Kanwal Sarai, founder of Simply Investing. It's a website that helps investors figure out how to be dividend investors. Kanwal, thanks for joining us. Really appreciate having you on the show.
Hello, Rob. I'm glad to be here, and I'm looking forward to our conversation today.
It's great to have you. We actually met at the FinCon conference in New Orleans last year, and it's this huge conference. There's tons of financial content creators, financial firms, all kinds of really interesting people that I spoke to. But I have to admit, you were one of the interesting folks that really stuck out to me. And one of the things that I was really taken by was your passion for dividend investing. That really shone through in our conversation. So lay it out for our audience here. Why do you like it so much?
This conversation can go on for 2-3 hours, right? Because this is my favorite topic. So to answer your question, I just love dividend stocks because of the consistent, reliable dividend income that I can get from those, right? And I don't, with the dividend increases, and we're going to get into that a little later in this conversation, I don't have to work extra hard. I don't have to put in more hours to make more income. But with dividends, you get more income over time as the dividends grow. So I just absolutely love dividends. I'm happy to share my knowledge with your audience, and let's get to it.
Less work, more play. That sounds like a pretty good arrangement here. I'm curious though, with your 12 rules, the $1 million question, right? What kind of results have you personally achieved following your 12 rules?
Yeah, so that's a very good question. I do have the track record up on the site. Folks can go look at it. I'm kind of behind. I have to fill in last year's data to put that in because we're just starting at the beginning of 2024 here. In terms of rate of return, it's going to be about, I've been doing this for 24 years. I track the stocks, I track the dividends. The rate of return is going to it's going to average out to what we see with sort of the S&P 500 index, the overall stock market returns, anywhere from 8 to 10% a year, right? But that's not my focus. My focus is not on the sort of the stock prices going up and tracking them. That's obviously nice if they continue to do that. My biggest thing is the dividend income. I'll share with your audience a little tidbit. I'll give you a little bit of information as much as I can because my wife's going to kill me if I get into specifics here. So my dividend income annually this year will do a little over $35,000 a year, less than $60,000. So in between there, that's what I'm making. Right? Sorry to be a little sort of obscure there, but just for privacy reasons, right? So we're doing over 5 figures a year in dividend income consistently.
Yeah, I don't want to get obviously too into your personal business or anything like that, but I mean, 5-figure dividend income annually, that's pretty darn good. I think, I'm thinking of the retiree who, they'll have CPP, they'll have OAS, and then to have that much dividend income would be a pretty great situation to be in for a lot of Canadians. Obviously, past performance is not indicative of future return here, but I have to say, over that long period of time, in my opinion, it seems like pretty compelling evidence that could give people some confidence in what they're doing. So anyway, I'm really excited to unpack this a little bit more with you here. But before we get into our conversation, I just want to have a quick call out to our viewers here. Make sure you subscribe to TD Direct Investing's YouTube page so you do not miss an episode of Inside Investing. You can let us know in the comments what you thought about today's episode, and you can let us know what you'd like to learn about more in the future. So with that out of the way, let's dive into our conversation, Kanwal. And I think maybe the logical place to start would be, why don't you tell us a little bit more about your style of dividend investing?
We're looking at blue chip stocks, mature companies that have been around for a very long time. So I don't get into crypto. I don't get into startups and IPOs. We're looking at mature companies because we're always looking at the track record of how the companies have done, right? Because nobody can predict the future. I don't know what's going to happen next week, next month, or next year in the stock market. Even with the stocks that I own, are they going to go up tomorrow? I don't know. I don't know where the market's going to be. So nobody can predict the future. So what we do is we look at the past. So for myself, I'll go look at the 20-year dividend history for a company. And is the dividend going up every year, or is it going down every year? If it's going down, I'm not interested in the stock. If the dividend is all over the place over the last 20 years, I'm not interested in the stock, because that's completely random. It doesn't tell me anything. So even though I can't predict the future, I can have a high degree of confidence that if a company has been growing its dividend over the last 20 years, growing its earnings over the last 20 years, then the company most likely will pay me a dividend next year and increase it hopefully as well. So the short answer is it's the value investing approach. I call it the dividend value investing approach, right? As you know, value investors, a pure value investor is going to look for a value play. Is the stock undervalued? I'm going to buy it. They're going to buy it, right? My approach is to combine the best of value investing. So we look for undervalued stocks and combine that with the best of dividend investing.
All right, so it sounds like we've got elements of dividend growth investing, but also value investing kind of woven in here. So really interesting approach. And one of the interesting things I know about your approach here is that you set a very high bar for what the investable universe of dividend stocks is for you. So much so that I believe it's something like 30 stocks right now in North America meet your criteria. That is a really high bar to clear for these stocks. So I'm just kind of curious. Do you ever wonder, like, am I missing out on, potentially great growth opportunities by setting such a high bar?
At the end of the day, I'm more concerned about the consistency and the reliability of the dividend income, because stock prices themselves are fleeting. Prices go up and down all the time. Somebody could buy a stock for $20 and it goes up to 50 and they're happy, but the next day it goes to 35. Now they're upset, or it goes down to 10. So I'm okay, and dividend investors and my students, we're okay with giving up a little bit of that extra 2 or 3% return for the safety, reliability, and the consistency. With dividend investing, we're never selling our stocks. So we're not eating into the capital. So again, if there's no dividends, well, every year you got to sell a few shares because you got to live off of that money eventually, right? Even in 2008, 2009, the financial crisis, the market tanked. In March of 2020 with COVID, the market tanked. But what happened to my dividend income? It's gone up every single year for the last 24 years. So that psychologically has a huge benefit. And then it gives you the confidence to move forward.
Okay, well, thanks for laying out the case for dividend investing, as it were, for us. Lots of great insight there. Now let's dig into those 12 golden rules of yours that have helped you research dividend stocks and kind of find some of those hidden gems along the way. Just a heads up that, with 12 rules on the docket here, we're going to have to bunch some of these together so we have enough time to touch on all of them. But let's get to this first batch here. So the first four rules are: rule number one, you must understand how the company makes money. Okay. Rule number two, the company's products or services must be needed for 20 years from now. Rule number three, the company must have a low cost competitive advantage. And rule number four, the company must be recession proof. So tell us, why are these four rules so important to you?
The first four rules are to ensure that we're investing in mature companies that are going to be around for the long haul and that they're recession proof, right? Let me ask you a quick question, Rob. If there is a chance you may lose your job, or there's a chance we're in the middle, if we were in the middle of a recession or economic downturn, are you going to go out and buy a brand new car?
Probably not. Probably not. I mean, I'm a pretty cheap individual. I'm not buying a brand new car regardless. If you saw what's in my driveway, you'd know that. But yeah, that would not be a good idea in my mind.
Yeah, there you go, right? So it's simple. It's common sense, right? Folks are not going to go out and spend 30, 40, $50,000 on a brand new car if we're in the middle of a recession and there's a chance they may lose their jobs. One more example. If you're out of a job, you still have to eat. You still have to brush your teeth, right? So you still need the essentials in life. When you come home, you turn the lights on, right? In the winter, you got to heat your home. You still have to do those things. So the companies that provide those products and services will be around for the long term, and they will continue to do well even if there is a market downturn or a recession.
Okay, I hear what you're saying. There's an element of stability and security there in those types of businesses. But one of the risks with investing in businesses like that is that they tend to be concentrated in a handful of sectors. I'm thinking utilities and telecoms and some financials and that kind of stuff. So, are you not concerned about a lack of diversification by focusing on those companies?
In Canada, it's a small market. So we have the five banks, we've got the three telecommunication companies, and then we've got some energy and oil companies, just a handful there. So for that to go beyond that diversification, I look to the US. So I have never planned it this way, but over the last 24 years now, when I look at the portfolio, pretty much half of it is in the US, half is in Canada. So in the US, we get a little bit more diversification because we have more companies and we have more international companies. If you look at a company like McDonald's, they operate in over 120 countries. Coca-Cola is in over 120 countries. Walmart, one of the largest employers in the world. They're operating all over the planet. But in my opinion, in the US and Canada, you're fine. You've got plenty of diversification and lots of choice there.
Now, you mentioned that you want to have companies that they have products and services that are going to be around for 20 plus years. Why would that be so important? I mean, what's the big deal if an investor invests some money in a company for a few years and then they just move their money somewhere else if that company kind of runs out of steam for whatever reason? Like, what's the advantage of investing in companies that are going to be around for the long haul?
Yeah. So you could do that, certainly, to watch a company and see how it's doing. Is it performing well? Is it not performing well? Is it in a dying industry? That requires a lot of time, effort, and research on your part. And my approach has been, some people call it the lazy approach to dividend investing. I call it sort of more the hands off approach. I don't have to monitor and watch those investments every month, every 6 months, every year, right? Constantly. Just fair. Okay, well, is their technology dying? Should I sell it now? Should I wait a couple of months? You know, timing it, it's very difficult, especially for retail investors. I think for any investor, it's difficult to perfectly time your exit from an investment that you own.
I believe that's a Warren Buffettism. Time in the market is better than timing the market, right? In any case, thanks for kind of clarifying all that stuff for us. Let's move on to rule number 5. Rule number 5 is that is the company consistently profitable? Why is profitability such a crucial factor here for you?
Because the dividend isn't paid from the stock price, it's paid from the earnings, right? And we want to see the graph trending upwards over the long term. For sure, the company's going to have a couple of years where it drops. 2008, 2009, a lot of companies had earnings that dropped. March 2020, COVID, earnings dropped. One or two drops here and there is not a problem. I'm looking at the long-term trend. So at the long-term trend, if a company has positive earnings, earnings per share, right? That's how much profit the company's making. Then I can have a high degree of confidence that they will continue to pay me a dividend and hopefully increase the dividend in the future. If I see the graph doing this, and there are companies out there, you can look at a 10-year or 20-year chart and you just see the earnings doing this, well, I'm not interested in that. That's too risky. The stock price can be going up and down. And, I've had people say, well, the stock price has gone up 25% this year. I'm like, yeah, okay, that's true. But look at the earnings. It's doing this. So we stay away from that. The other one we stay away from is where the earnings are erratic. It's completely random. And I look at that graph and I have no confidence as to what's going to happen next year. So earnings are extremely important to look for.
So you mentioned you don't like to see that erratic kind of nature in earnings. How erratic is acceptable to you? You mentioned that 1 or 2 bad years in the mix of a good trend, that's okay. But how erratic can things get before you say, look, I just don't have confidence in this?
Yep. So if I look at a 20-year chart, I can accept in 20 years, maybe 5 drops, 5 or 6 sort of drops where the earning went down a little bit, right? And that's it. Overall, I want to see the earnings continue to grow in the long term.
Okay, I want to circle back on rule 5 for a little bit here because there are a couple like qualifiers that you have for it. So let's say 5A, if you will, is the average earnings per share growth must be 8% or more over the last 20 years. And 5B is that there must be at least 8 increases in earnings per share in the last 20 years. So, what's the rationale behind these specific thresholds?
So the answer is that I've spent the last 24 years trying to simplify the rules, not to have 30 or 40 rules, because that would take forever to research, to simplify the rules and get to the essence, the fundamentals of what is important. And then through trial and error with my own portfolio and looking at how companies performed, basically experimentation on my part. And that's where I came up with those numbers. So the 12 rules is your checklist. This is it. If a company fails even one rule, skip it, move on to something else.
All right, let's move on to the next batch of rules here, and they pertain specifically to the dividend payout itself. So, rule number 6, the average dividend growth rate must be 8% or more over the past 20 years. Rule 7, the dividend payout ratio must be 75% or less. And rule 8, the long-term debt to equity ratio must be 70% or less. So, why are these specific metrics so important to you?
Because that's going to give us the confidence that a company that has that track record is going to be able to pay us a dividend next year and hopefully increase the dividend next year. So same thing applies. If I look at the graph of dividends and I see it doing this, that just means the company's cutting the dividend every single year, every single year. They've been doing it for 20 years. What do you think is going to happen next year? It's probably going to go down again. So I'm not interested in that. And then there's companies that pay a dividend, cancel the dividend, pay it again, lower it, pay it, cancel it, and it's just completely random. And I'm not going to name any names, but there are companies out there. I've looked at the graphs myself. When I see that, skip it, move on to something else. I have no confidence what's going to happen next year.
Yeah, it's kind of like that friend that says, yeah, I'm in, count me in. And then 15 minutes before they're supposed to meet at wherever you guys are going, it's actually, I can't make it.
Yeah, absolutely. Right. And the company could be paying a dividend today, but if I look at the 20-year history and it's random, that dividend might get reduced, might get cut, might go up, but I don't want to take that chance. It's just too risky. So we're going to leave that out altogether. Rule number 7, very quickly, the payout ratio, super important. And again, this is, I want to bring everything down to the fundamentals and the essence, and it's common sense, right? So let me ask you this, and we're going to make this really quick. I'm going to give you 2 examples, Company A and Company B. Company A has earnings of $2 a share, and they pay out a dividend of $1 per share, right? So 50% payout ratio. 50% of what the company made, they gave back to the shareholders as a dividend, and the rest of the money they kept and they reinvested back in the company to grow the company. So that's Company A. Company B also has earnings of $2 per share, but they're paying a dividend of $3 to the shareholders. All things considered equal, which company do you avoid?
I don't know where Company B is getting that money from.
There you go. Right? You would avoid Company B. Where are they getting the money from? They only made $2 in earnings, but they're paying $3 a dividend to the shareholders. That makes no sense. Where are they getting the money from? They're probably borrowing it from someplace else to be able to pay the shareholders. All that means is they either have to get the earnings up or they're going to cut the dividend. And as a dividend investor, I don't want to take that risk that they're going to cut the dividend. Okay. Let's go to rule number 8, the debt. Super simple. I'll keep it simple again. Let's go with Company A and Company B. Company A has a debt of 5%. Company B has a debt of 600%. All things considered equal, Rob, which company do you avoid?
Well, sure, yeah. I mean, Company B, obviously. That's a little bit of a cartoonish example, though. Like, let's say it's a little bit closer than that, right? Like, maybe it's like 5% and 25% or something like that.
Right. I gave you an extreme example just to illustrate the difference. Now, there are companies today in the US and in Canada that have a debt of 800%, 900%. Rule number 8 is to help you make a quick decision. So you're looking at a company that's got 68% debt level and another one's got 94%. Well, skip the 94 one, move on, right? So that's where we cut it off at 70%. Now, there are subtleties in there, and let me just spend 30 seconds on it because that's a whole different topic in there as well, right? So if you're looking at utilities, for example, right, they usually carry a lot of debt. just because of the business that they're in. They need to borrow a lot of money for a lot of material costs that are extremely high. So they usually revolve around 90%, 100% debt. But for 90% of the time, stick with rule number 8, 70% or less.
And the general idea here is that if a company had a really high debt burden, it would potentially put into jeopardy their ability to pay that dividend and raise that dividend in the future.
Absolutely. And also, a company with very high debt is going to have a very hard time paying off its loans if there's a recession and if the interest rates are extremely high.
Ooh, higher interest rates. Where have I heard that one before?
Yeah.
Anyway, let's kind of build on that theme of sustainability here with your next two rules here. So rule number 9 is avoid companies with a recent dividend cut. And rule 10 is the company should actively buy back its own shares. So what does meeting these two criteria suggest to you about the company's long-term trajectory here?
Yeah, absolutely. So, rule number 9, let's start with that one first. Okay. Now, to explain rule number 9, it's important to know that when a company increases its dividend, all things considered equal, when a company announces a dividend increase, that is a positive sign for sure for dividend investors because we're going to get more money. But it's also a positive sign that the company has done its homework, that they feel confident in their financial ability to be able to pay a higher dividend, right? Here's the thing with dividends. You can't lie about the dividends, right? Geraldine Wace wrote a fantastic book called Dividends Don't Lie, because dividends are paid to the shareholders in cash, gets directly deposited into your trading account. You either pay the dividend or you don't. You either have the cash to pay it or you don't, right? So a dividend increase is generally a very positive sign for us. Company's healthy, they're going to be able to pay it. The opposite is when they reduce the dividend or they cut it. So when that happens, that tells me that the company doesn't have enough money to pay the dividend next year or the next quarter. It tells me that perhaps they're in some financial trouble that they can't pay the dividend. So that's rule number 9. If there's a dividend reduction or a dividend cut that they just announced, well, don't buy the stock. We're trying to minimize risk here. Every one of the rules is designed to minimize our risk. Okay, so that takes care of that. Number 10, does the company actively buy back shares? Again, generally, this is good for investors as the company buybacks its own shares. The number of outstanding shares in the market gets reduced. And over the long term, if there's less shares out there, the stock price will gradually come up. Doesn't happen overnight, takes time, but it will generally come up. So that's a good news for us as well.
Right, because even dividend investors want the share price to go up, right? Nobody doesn't care about that completely, right?
Yeah.
Just to kind of circle back on that thing that you mentioned there about the dividend cuts. Let's say a company cuts its dividend. Could you not argue that, well, the worst is over. They've already ripped the Band-Aid off, so to speak. So there could be some upside to be had from here. So like I'm thinking if you hold a stock that cuts its dividend, do you knee-jerk sell it or do you hang on? Do you kind of assess the situation? What do you do?
If there is a dividend cut, isn't now the company a good buy because they've already made their cut? The answer to that is we don't know if there's going to be another cut coming afterwards, right? A good example was GE, where they had 2 or 3 years of dividend cuts, right? So we don't know what's going to happen in the following year. Is it just one cut or is it going to be 2 or 3 more? So we don't know. So the risk is too high, so we just avoid it, right? We're all about minimizing risk. Okay. What do you do when there's a dividend cut, right? There's a couple of things to consider. How much did you pay for the shares? How long have you owned them? In the case of dividend investors, and same with myself, I now own stocks, and I'll give you a really quick example here. Back in 2000, so that was a long time ago. It was a $2,500 investment. Since then, the company has paid me over $8,900 in dividends. So my capital is covered. Like it's already paid back. So in that case, if the company cuts the dividend, I don't have to hesitate. I can sell the shares, right? Because I've already made my money back. We're good. If it's a company you just bought a month ago and now the company announces a dividend cut, Are the shares trading around the same price where you bought them at? If so, you can just sell it. You're done. If the shares are much lower now we're getting to the whole psychological elements here. Because personally, I hate to sell at a loss. I don't know what it is. I just hate it. And so it's hard to give a black and white answer there.
I want to spend a little bit of time on this next rule because it's kind of the crux of a lot of what your research boils down to here. And there's a lot to unpack. So, rule 11 is the stock must be undervalued. Okay. And there's a few qualifiers here. So, 11A, the price to earnings ratio must be 25 or less. 11B, the current dividend yield must be higher than its average over the past 20 years. And 11C, the price to book ratio must be 3 or less. So, like I said, that's a lot there. So let's start with the first and the third sub rules, if you will. Why is it that a lower PE and a lower price to book ratio are important metrics for you?
At the end of the day, we don't want to overpay for a stock. Let's say you were going to invest $1,000 in company A and company B. Company A was undervalued, it was priced low historically, and company B was priced like way high, right? Let's just simplify. Let's say it was $10 a share. Company B was $80 a share. With the same $1,000 investment, you're going to be able to buy more shares in company A. Assuming the dividend is the same, $1 per share for both companies, you're going to make more in dividends with company A because it's priced low. You're able to buy more shares with the same amount of money you were going to invest in. And remember, the dividend is paid to you based on the number of shares you own, not on the stock price. So if you can buy more shares at a lower cost, you're going to get more in dividends. So historically, PE 25 or less is good for us for what we look at. There's companies today that are trading at PE of like 50 or 80 or 100. That is way over. To me, that's overvalued. Like you are paying too much for one share in that company. And the same thing with PB. We want to stay at 3 or less. Anything higher like 10, 12, 20 PB, that you're paying way more than what the company is intrinsically worth, right? That's the book value. So again, I don't know, that could be another 20-minute conversation about what is book value and how do you figure that out. But for simplicity's sake, PB of 3 or less is going to be fine.
All right, now I want to make sure that we circle back on that second sub rule here, because you've called this one a little bit of a research hack that can kind of greatly accelerate your process here. Everybody loves life hacks, Kanwal. So can you unpack that for me? Why is it that the current dividend yield being higher than the 20-year average is so important, and how can it kind of accelerate this research process that you have?
So if that's true, then what you're looking at is a company that is priced low or undervalued. That's what we refer to them as, undervalued. Companies either going to be undervalued or overvalued. Any company in the world today is either undervalued or overvalued. And so Rule 11B is a quick way to check if it is. So here's the hack. Instead of spending time going through all of the 12 rules that we talked about today, first thing you should do is go to Rule 11B, check the current dividend compared to the average 20-year. If the stock is not undervalued, okay, then skip the rest of the rules and move on to something else.
All right, again, that less work, more playtime. I like that. I like that. So, do you ever make exceptions to your rules? I really like this, stock, and yeah, it doesn't meet this rule, but it meets everything else. I'm going to go for it anyway. Is that ever part of your process?
So we talked about it briefly earlier in this episode. Was the payout ratio? The debt. Rule number 8, right? The debt must be 70% or less. Well, when you look at utilities, those companies generally carry a higher level of debt. It's usually around 100, 120%. So that's where you can then look into, okay, what are the top 5 utilities in Canada? What is their debt level? And the one you're looking at, is it within their average of those 5? If it is, then you're good. Then for you, rule number 8 will pass and you can move on. So there are subtle exceptions. Rule number 11B is non-negotiable. You should never, I have never in 24 years bought a stock that was overvalued.
Are there any other ones that are just non-negotiable that you absolutely have to see it?
Rule number 4, like the company's got to be recession proof. Like otherwise you're just putting your money at risk in cyclical companies that go up and down, right? If you're going to put $10,000 in, I don't know, in a car company or an airline, and then we end up with a situation where there's a recession that's going to last for 12 months or 18 months or 24 months, they're all going to be down, right? So that would be non-negotiable. Rule number two, want to make sure the product and services are around. So those are non-negotiable.
All right, well, let's round out this list then with your 12th rule. This is a behavioral one. It's don't let emotions get in the way of your investing decisions. I've definitely heard this one echoed by other types of investors across the investing world here. It's easier said than done, certainly. But why, for dividend investors, do you think this is one to really take to heart?
In order to be successful, especially as a dividend investor, you want to be disciplined and you want to have patience. So discipline to stick to the 12 rules, right? We don't want to apply the rules now and then 6 months from now throw everything out the window and start chasing the latest IPOs, right? You're just then there's transaction costs, of course, of selling the shares and then buying new ones, and then time and effort to go research IPOs and what are they doing and all that. So disciplined, stick to the rules. Patience is the other one. Stock markets go up and down. Everything is sort of cyclical. We see recessions, we see market crashes, and then the market comes back up again. The worst time to sell is when the market is down. So what we're talking about today is long-term investing, 10, 15, 20 years more, right? So it's ideal for a TFSA, for an RRSP, for the long term. So we can ride out the market downturns, and they will happen. We will see market crashes. But as long as the dividends are coming in, and as long as the dividends are growing every year, you'll be fine.
All right, Kanwal, we're going to have to leave it there. Thank you so much for filling us in on your 12 golden rules for dividend investing. Do you have anything else to throw in there that we didn't pick up on in our conversation?
Thank you for having me, Rob. I appreciate it. This has been a lot of fun for me. The one thing I want to leave your audience with is give yourself time. Don't rush into things. Don't panic when stock prices tank. If you've done your homework and you've done the 12 rules and you buy a stock today for $25 and it drops to 20 tomorrow, that's okay. You've done your homework. We're relying, our focus is not on the stock price, but on the dividend income itself. That's the number one priority. So give yourself time, be disciplined, and be patient. Unless you've got a lot of money that you're sitting on, and I'm not, right? It takes time. So you got to start small. And you talked about it in the beginning about the snowball effect. And as it compounds, then you get into a position where you're now making 5 figures a year in dividend income. So give yourself time and you'll be fine.
Fantastic perspective. Thanks again so much for joining us, Kanwal. Really appreciate it. And thank you to our audience for tuning in as well. Just remember, make sure to register for our upcoming live webinars and check out our library of on-demand content as well if you want to learn all about other types of dividend investing and investing topics in general. There's a lot of great stuff in there, so check it out. Thanks again for joining us, and we'll see you all next time. Have more questions? Then check out the links to the right and in the description below.